You got $16,400. What I want you to see here is the client stopped making his premium payments at 60. You've come up to this guy and he's saying, hey, look, if I don't go any longer, what happens to my policy here? Well, if he goes no longer on a guarantee side, it's going to lapse at age 75. If it stays on the current side at 3% in a traditional UL policy, it's going to lapse at age 84. Go to the next page. Go to page 3. Well, what if I reduce the face amount down? Or, excuse me, what's the likelihood of my life expectancy? This is kind of interesting. You'll notice, when did the policy lapse?
84.
Go to page 4. What's the client's life expectancy? 84. Amazing how that worked out, isn't it? You want to watch those kind of situations. And what do we know about life expectancy? Half the people are going to still be alive and half the people will be dead. So that means over 50% of the population in this case would be alive and have no insurance. That's where your clients are today that are out there that have the universal life. And you'll notice I didn't pick on anybody else. I picked on us. I used a Lincoln traditional UL policy. Go to page 5. I said, now what happens if we drop the face amount? Because we'll do a reduced paid up, for lack of a better term. In this case, we can do a reduced paid up to $865 on a guarantee basis. It'll lapse at 76, and on a current basis, if you'll go to page 7, it lapses on a current basis at age 86. Well, at least we got him beyond normal life expectancy. That $230 grand that he had in there into a guaranteed death benefit product, in this case would be a Lincoln guaranteed death benefit product. The $1 million will stay in force to 93, where before it was going to be gone in the early 80s, and on a guarantee basis was going to be gone much sooner than that. It would be gone around 74. If we reduce the face amount down to that 865 on page 9 and 10, you'll see that it goes forever. What I want you to understand from this is there is a marketplace out there for these policies that have gotten themselves in trouble. When people brought out products, I was there when Universal Life started. I don't mean I was kind of in the neighborhood. They used to run full-page ads of my picture in the National Underwriter by a little company called Life of California that became E.F. Hutton. I was there. They used to run full-page ads, come meet Mr. Universal. So I can tell you who bought the very first contract. It was the actuary. He was the one whose policy they used to file for the private letter ruling that everybody built their cases on. So I've been there for a while. I've seen the good, the bad, and the ugly as it relates to universal life insurance. I've been there since its inception. There are a lot of contracts out there where people are running illustrations when they sold them at 8, 9, and 10% because we know that interest can only go one way. The bottom line there is, I want you to understand that there is a market out there, as to play off what Mickey said. He asked me to make sure we covered that. You folks need to be reviewing those things. The worst possible thing that you could have is a client who's been stuffing money into a contract, ours or someone else's, only to find out at the time they're going to need it, it's not going to be there. I'm going to tell you how to set this up, and I want you to pay real close attention. If you don't listen to anything else I've said to you today, listen to about the next 2 minutes. You're out talking to a client. You're talking to this client, and you come across an asset. It could be a CD, an IRA. It could be a mutual fund. It could be an annuity. It could be qualified or non-qualified. You're talking to them about this asset. You ask the following question. Make sure you remember the question. What is the purpose of this asset? If they respond with this answer, or something close to it, I want my children to get this. I want my church to get this. I want someone else to get it. I'm not going to consume it. I want somebody else to get this. Here is the question that you then ask that I have never had anyone say to me no. In my entire career, I have never had them say no to this. Now, they have not always bought, but they have always said yes to this next question. Would you like to know the most tax-efficient way to get it to them?